James, how did the Harmony portfolios perform in October?
October was a topsy-turvy month. It had the usual market forces. It had exogenous shocks in the form of Hurricane Sandy. It had the spectre of a US election, all wrapped up into 1 month. And overall, we had a slightly weak global equity market over that period, largely driven by a 2% decline in the US. The devil's in the detail though, because elsewhere in global markets, equities weren't too bad actually, and you had pockets of actually quite reasonable returns. We've been saying for a couple of months we think that the markets are due a bit of a pause, and so to have a degree of consolidation in October was welcome. But when local markets like Australia, for example, up 3% in local currency terms, Europe up, and the UK up, it's not as clear a picture actually once the dust has settled on the month than you might think just by looking at the global equity returns numbers. All of the funds, with the exception of the two US dollar balanced in growth, were in positive territory in absolute terms, but because of this regional differentiation in returns, we had sort of mixed relative numbers, but generally speaking we were within a similar range, or within a reasonable range to the benchmark's return over this period.
You've spoken there about returns to regions effectively. Were there any sectors that came to the fore last month?
Yeah, well, we've been repositioning the funds, rotating into deeper value stocks. As this rally has continued, we've taken the view that the main beneficiaries of this rally, particularly the quality stocks, if you like, have perhaps become a little bit expensive, certainly not cheap anymore. Deep value stocks, however, are reasonably attractive valuation-wise, certainly more attractive than elsewhere in the markets. We've been rotating into that. And interestingly, I think in October we saw just the start of the deeper value sectors, the consumer discretionary and the financials actually outperforming other sectors of the market. And so I think we're starting to see that trade come to fruition. Having said that though, there is a degree of locality still in those returns. So for example, in the UK and Europe, we saw this deep value outperformance. In the US, pretty much everything fell roughly in line, so you can't have that same differentiation there. And likewise, in the Asia Pacific ex-Japan region in October, pretty much every sector rallied the same amount. So there's a degree of lower discrimination in some regions and far more discrimination in other regions between the sectors.
So stylistically, we're looking at possibly value over, say, quality. Did you elect to make any other changes to the portfolios last month?
We were quite quiet on the portfolios last month. We've spent the last few months putting into position a lot of sort of slightly more finer trades, if you like, smaller positions in terms of inflation-protected securities, which we've taken on a relative value basis over global governments, and also on the basis that while inflation is not today's problem, we expect it to be an increasing problem in the coming years as this extraordinary monetary policy starts to bite in the markets. So our positioning broadly is as it's been for a month or so: 2% underweight on the equity holdings, roughly 3% underweight global property securities. We can come back to that because that's again not helped us this month. Underweight global government bonds, which was generally beneficial with the exception of Europe, which was reasonably positive as sentiment improves with respect to that region. We are overweight investment grade credit, high yield, convertibles, and also using tactically strategic bond managers in that fixed income bucket. And we're also overweight cash as well, on the basis that with a lot of fixed income valuations, particularly in the high quality part of the market, being a bit stretched, equity market valuations now appearing a little stretched as well, cash is quite a logical holding pen, if you like, and we're waiting with that dry powder for opportunities to present themselves going forwards. On the property security side, I think I should mention that as well. We were 3% underweight that sector, and as I mentioned earlier, the financial sector, generally property securities are part of that sector, and that was again strong in October. I think that sector is looking expensive. We are remaining underweight in that sector, and when we will add back into that area, we're going to be moving more towards the infrastructure security side of the market, a bit more dependable, quality orientated if you like, but not expensive in the way that the broader quality sector or style, if you like, is.
And finally, James, I'm sure you and Glyn have spoken to the political changes that are to come, but what else do investors have to look forward to?
Speaking very technically, the last couple of months of the year tend to be positive, and just the mood in the markets generally is reasonably positive at the moment. And I think the point that Glyn made earlier in the other podcast was the fact that although on the face of it markets are down, it's still been a risk-on period in October, and we sort of expect that to continue, but we remain underweight equities slightly on the basis that they have come a long way quite quickly. The middle of the year, certainly the last 3 or 4 months have been very strong. October less so, but still positive for risk assets. We think generally that it's worth just being a bit circumspect about the prospects of that continuing to the end of the year. Clearly, US election is a risk. I think it's largely priced in. I don't think there's going to be too many surprises there. It looks as though it will be an Obama victory. We'll find out literally 24 hours from now. The Americans have just started to go to the polls now. Having said that, if it is a Romney victory, how much of an impact that will have on the markets, again, I don't think it's a particularly massive one. The biggest risk is probably a small marginal win either way, because that brings in a degree of political difficulty with respect to the fiscal cliff in the US, which clearly needs to be addressed pretty quickly. Having said that, though, I think it's such a political impact, such a big deal, that I think it will overcome politics. It will be a cross-party resolution for that one way or another anyway. So although there will be probably short-term sniping over it and some point scoring, ultimately the resolution of that issue has to be a cross-party event. Elsewhere, clearly other political changes going on. The China change, that's coming up this month as well. I think it's likely to be well-managed transition. That's generally the way Chinese politics works. It's sort of nicely stage managed, and I don't think the impact on the markets will be material there, but it is a risk, bear in mind that one as well. Finally, we've all become a little bit sanguine about Europe. There's so much consolidation that needs to take place there from a fiscal point of view. Clearly there's political resolution still required for the longer term Euro project, and there'll be plenty of horse trading on that next year, I suspect, as well. So although Europe has come a long way in very short order, Mario Draghi is doing anything it takes to save the euro, has reduced any imminent risks or significantly reduced imminent risks in the portfolio. We mustn't become complacent. Europe still has the capability of surprising us, so don't become too relaxed about the risks there as well.
James, thank you very much.
Thanks, Richard.